Um, just a minute. Welcome all participants. I'm not able to see how many participants we have so far. So I welcome all our members to this webinar on PMLA, organized by the Institute of Company Secretaries of India. So PMLA stands for the Prevention of Money Laundering Act 2002, and we have with us today Shri Ritik Pandey, IAS Joint Secretary, Revenue and Ministry of Finance. Shri Sark Swine, Director, FATA, Department of Revenue, Ministry of Finance, and Dr. M. Satya Kumar, Advocate, the Supreme Court of India. So I would just briefly give, a very short introduction of PMLA, and then we move to the introduction of our speakers today, our esteemed panelists and guests for this session today. So PMLA stands for the Prevention of Money Laundering Act, and it has been for long. It has been a dreaded act enacted by the Parliament. So, like, exactly it is. We recently have come across, a lot of discussion about how company secretaries have come under the purview of this provision of this act now. So basically, yes, we know about doctors and engineers, like the people who provide services are often charged of negligence, and they have to be more cautious about their duties and provide provision of services. So now, with the inclusion of company secretaries within the ambit of this PMLA Act, we have also to be very cautious about our duties when we perform our duties towards our client. Now, the Prevention of Money Laundering Act 2002, along with the rules framed thereunder, came into effect from 1st July 2005, and the idea was to prevent the heinous activity of money laundering within the country, and it was to aid the global efforts against money laundering and other related crimes like terrorism, with a view to combating such illegal activity. Punishment, imprisonment, also provides for confiscation of property using that fund. Is like I don't want to take that time from the we have a faculty for that, Dr. Satya Kumar. So, but if required, I would say this the definition later also. To start with, I would like to have our guest speaker first, but before that, I'll just brief out. On 3rd of May, we had a notification which practicing secretaries, practicing chartered now with and like activities when they engage in activities like management of savings or security service organization for the creation operation or creation of partnerships and buying and selling. So all these three questions, the professional are included within the ambit. Now again, on 9th of May, there was another notification which provided the list of financial services which in performance of which secretary, practicing company secretary, coming under the ambit of this Money Laundering Prevention Act. So I'm sure Dr. Satya Kumar is going to run our participants through that. So just I would start. I would request our guest today to start delivery. Dr. Shri Pandey is in the Indian Institute of Technology, Kanpur. I'm good. He's an Indian Administrative Service Officer, 1998 batch, and he belongs to Karnataka. He has operational and exposure to direct and indirect as well as the money policy, taxes and money laundering policy. He has worked as the chief of the commercial tax department in Bangalore. He was spearheaded the GST of India since its inception.
Hello.
Yeah.
Ma'am, the voice is not clear. It's breaking.
Okay. So is it now?
Now it's slightly better, ma'am.
Is it now? Should I?
Now it's slightly
Okay.
better, but it's still cracking.
So should I just switch off the video?
Yes,
Maybe?
yes, ma'am. You can.
So I
do
get
it.
better bandwidth.
Yes, ma'am. Yes, ma'am.
Is it better now?
Yes, ma'am.
Is it better now?
Yes, yes.
Okay, so yeah, Sri Ritvik Pandey is now the co-chair of the Operations Committee of Asia Pacific Group. There's some technical thing. Am I now again? Can somebody please tell me from the ICSI HQ if I'm audible? Yes, ma'am. Okay, so there was some connectivity issue. So I hope the profile of Mr. Ritvik Pandey was audible. Do you want me to repeat that?
No, ma'am.
No, it's okay.
Okay, thank you so much. So I would now invite Mr. Ritvik Pandey to deliberate on this particular very hot topic of PMLA and the company secretaries under this the new notification that have come that has named us as the persons we are under the ambit of the PMLA. So please deliberate on this.
So thank you very much. Today's agenda is mainly to brief the members about what FATF is in short, and what is the expectation from the countries across the globe, and what is what they call something called risk-based approach, and how countries follow the risk-based approach. And then we will also talk about the national risk which India has done consequent to on the way, FATF requires every country to understand the risks that they are facing. And we'll also focus upon as to what are we expecting from the members as per the this whole what should one say, the responsibility matrix of everybody. What are we expecting from the members here? Just to kind of briefly tell you that mainly why professionals become important is because you are basically the gatekeepers of entities that may be involved in money laundering, terror financing, and also many people, because you are professionals, many people may be approaching professionals and knowingly or unknowingly you may be aiding or helping people launder proceeds of money or funnel money into terrorist financing and all. Basic what FATF requires mainly is to for professionals to have some minimum due diligence, some preventive measures to ensure that these kind of that the money launderers and terror financiers, they cannot really misuse the services of professionals to achieve their objective. So just to be in short, FATF, what FATF is a intergovernmental body. It's an international body which sets standards for anti-money laundering and terror financing the framework that countries should follow. Their standards are in form of recommendations. Recommendations, so they have some 40 recommendations ranging from that countries should require financial institutions and professionals to do due diligence. Countries should criminalize money laundering. Countries should criminalize terror financing. Countries should ensure that regulators in their country have adequate powers. Countries should ensure that they require international cooperation in investigation of money laundering and terror financing incidences, or where required extradition of fugitive criminals should take place. Countries should cooperate. So similar things, there's a range of 40 recommendations, and what they do is that to ensure that countries are following their recommendations, they have a process of peer review. They have a methodology for doing the peer review where they assess countries on compliance against these 40 recommendations in terms of technical compliance, in the sense that whether it is happening or not, and also in terms of effectiveness as to how well it is happening. So, and on the basis of evaluation, they have a very elaborate process of follow-up. They have something called a gray list. They have something called a black list. And they also call upon countries, their members and the countries in the global network to impose financial sanctions on the countries which do not have adequate financial systems to prevent money laundering. So mainly the thing is that the world is connected. So money can move from one jurisdiction to another jurisdiction very with a click of a button today. And if there is a jurisdiction where people can float shell companies and launder money very easily or finance terrorism very easily, then what happens is that everybody is risky, because the one country has left its loopholes open. Everybody is at risk because people can use those jurisdictions to start funneling laundered money or start financing of terrorism. So therefore, it is better if everybody else isolates themselves from that particular country. We do not allow fund transfer from that country. We do not allow investments into that country or from that country, kind of, sanctions. So they have these kind of elaborate mechanisms, and that is how FATF globally has become very important, and they have been very effective in ensuring that, most of these preventive and curative measures have been implemented by a large number of countries. I mean, you must have seen in news and all that Pakistan has been in grey list for a long period of time, around 7-8 years. They just now recently came out of grey list after taking a host of reform measures to in the direction of changing their financial systems. So what FATF requires is that countries should follow a risk-based approach, in the sense that where risk is more, countries should focus on that. Where risk is less, countries need to be slightly focus their resources to places where risk is more. So the risk-based approach requires countries to assess what their money laundering, terror financing risks are, and take measures to ensure that these risks are mitigated. Next slide. So in the risk-based approach, the way the methodology which is followed, or we have also followed, is that these are the main components of risk-based approach. Where, so like for example, everybody should know where. So suppose let us take example of a bank. Say for example, a big bank like State Bank of India is in across the country. They are operating in Jammu Kashmir. They are operating. They are also operating in Mumbai. They are also operating in Bangalore, and they are also operating in Northeast and even Naxal areas. So the point is that a State Bank of India should also understand what risks their business is having, and therefore they should also their entire staff should be aware of what the risks are. So people who are operating in Jammu Kashmir, they should be aware of what kind of risks their bank faces from the kind of situation that they are in. Regular training, for example, is very important component of a risk-based approach, where new people keep coming, new risks keep emerging. So today, if we see, you also as professionals must be seeing that there'll be a trend of how say for example, perpetrators are using the existing system, because system is also evolving, and the methodologies, the methods of are also evolving. So therefore there is a very important requirement of regular training and all. So there are these are various important components of the risk-based approach. Next slide. So first thing is actually to understand what the risk is. So what FATF says is that all countries should do a risk analysis of their own, of the what risk the country faces. Of the risk analysis, there are two components of it. One is the threat. So what threat is country exposed to? Now, threat is a very external factor. It will depend on various geopolitical situation. It will depend on the kind of population, the kind of financial transactions that are happening. So threat will come from that. So threat of say Hong Kong is very different from threat of say London, which would be very different from say threat of India, and say threat in Brazil, or threat in Japan. So threat is something which is very external. And then how this threat is to the financial system, which may have its vulnerabilities. So vulnerability is a very systemic issue. So if the threat is there and the system is also vulnerable, that means the risk is high. Threat may be high, but if the system is not vulnerable, if the vulnerability is very low, then the risk becomes low simply because there are mitigating factors to handle that risk. Even if the threat is low and the vulnerability is very high, because the system is completely open, unless the threat is almost very, very low, if the threat is something medium, the system is very open, then also the risk becomes high, and countries should ensure that adequate mitigating measures should be taken. So the first component is what we call the threat assessment. And the way we approach is that we use the data collected by Crime Records Bureau, which is a repository of all criminal investigations going on in the country. We take information of money laundering investigations being done by Enforcement Directorate. We take various typologies cases investigated by various law enforcement agencies. There is a system of suspicious transaction reports to be filed with the Financial Intelligence Unit, which is filed by what we call the reporting entity, which they file when they feel that there is a transaction which does not match. There is no economic rationale for a transaction having taken place. And it is completely, out of sync. I mean, it's something which they have been seeing till now. This is looking very suspicious. And reporting entities report this to FIU, which becomes, it is like an intelligence input. So that also gives us some idea about what the threats are. Next. And so then what we do is do that for every particular criminal action, every particular class of crime. what is the severity of that offense? Certain offenses will be far more severe as compared to some other offenses. Then some offenses may be very severe, but actually the proceeds of crime, the amount involved in such criminal action may not be there. While they are very big threat to the society, and they are leading to social impact, but they may not be a risk to the financial system of the country. But here, because we are mainly looking at the threat to the financial system, we modulate the threat based on the quantum of proceeds of crime involved in a particular offense. Then regional variation plays a very important role. Crimes which are very specific to a particular region carry less threat, because there you only need to develop systems or to have a watch or to take corrective action only in those regions where these kind of activities are taking place. Those which are all pervasive are more, the threat is slightly more, mainly because effort required to mitigate is higher. Similarly, cross-border movement is there that increases the threat perception. If entities are complex, if suppose legal persons are involved, companies, corporations, LLPs, layering of companies, then it becomes much more complex. If the influential people are involved in a particular crime, that makes it more the threat. It increases the threat perception of that particular crime. So based on this based on this analysis, this is the screen. This is the one shot picture of the threat assessment of our country, which shows that fraud is one of the highest, having the highest threat perception in our. Fraud has the highest. Our financial system faces highest threat from fraud, which is mainly coming from 2-3 kinds of frauds which are being seen. One is like banking fraud, then we're seeing in recent days we have been seeing even cyber frauds and all. Illicit trafficking of drugs, corruption and bribery, and forgery. Forgery actually goes along with fraud. These are rated as medium high. From the data shows that the threat from these are medium high. Then these are the remaining ones like terrorism, arms trafficking, counterfeit currency, smuggling. These are all carry medium risk, and the others carry actually medium low or low risks. So normally what countries will do is that they will focus on the high and medium high risk portfolio and try to see how they can be mitigated and how systems are exposed to these threats. Next. So the next is actually vulnerability analysis. As I said, risk is a factor of the threat and the vulnerability. So what are the key focus today that are making our systems vulnerable? So one of them, say for example, is a beneficial ownership regime, which we are seeing of late has become a very major challenge for everybody, for financial institutions, even say for example for professionals. For law enforcement agencies, layering of corporate structures, layering of legal structures has made it more complex, and try to break the corporate wheel, to expose the corporate wheel, to lift the corporate wheel and reach the final human being as to who is running this entire show, has been becoming more and more problem, and that is a vulnerability. And this is not something which is limited to India. This is something which is being observed worldwide. For today, FATF is grappling with this thing, and countries are collectively trying to solve this issue as to how this can be handled. We are seeing that as and when financial systems have been tightening they have been closing their windows tightly. We are seeing that crypto, the virtual asset sector, cryptocurrencies and likes have become very sought after instruments for illegal activity, and they pose a huge vulnerability in that sense. Now of late we have started regulating them also to ensure that there also the similar kind of vigilance is kept as is for say financial sector. Then fintech services, on one side, while they may have eased the life of millions and billions, in terms of faster access to financial services, in predictability in financial services, more transparency, better costs. It has also therefore made life easy for even money launderers and terror financiers. So these are some examples of what are the key focus areas which are impacting vulnerability which are impacting in increasing or assessing the vulnerability of any financial system. Next. So from the sector side, this is how our the sectoral assessment looks like. So banking is something which is seen, the threat is seen as medium high, simply because in all transactions, anything which is happening somewhere or the other, the banking sector is being touched. So there is it is very difficult to actually escape banking per se, other than very completely cash based networks going around. Everywhere, somewhere or the other, actually bank is getting involved. So the threat of banking sector is medium high, but the vulnerability is medium low, simply because the kind of checks and balances which have come in banking sector now, in terms of CDD, in terms of enhanced CDD, in terms of suspicious transaction filing and everything, the vulnerability of banking sector is assessed as medium low, and therefore the risk is medium. For the securities market, the threat is slightly low for 2-3 reasons. One, because the reach of the market itself is slightly low. The second is that the checks and balances are the access to it itself is also it's not very easily accessible to people. I mean, it is the limit, the instruments are limited, the avenues are limited, and therefore the threat becomes slightly lower. The vulnerability of security sector is also medium low. In fact, they have a slightly tougher checks and balances as compared to banking sector, and the risk is therefore medium even in security sector. For insurance and premium in our country, there is not much of a concern. The threat is also low. In not many cases we are seeing insurance related, I mean, where insurance sector has been used for money laundering or terror financing. Similar is pensions. So these are the 4 financial sectors which are very critical for FATF point of view. Then there are these 4 from 5 to 8 serial number. These are non-financial business and professions, but these are under the ambit of FATF simply because they have a very tight, they have a financial nature. I mean, they are also they are from the purpose of money laundering, terror financing. They are as if they have the same use as the financial sector. So real estate in our country, the threat is high. This is very much observed in the kind of cases that the law enforcement agencies are investigating, which actually shows that the threat is high. And also because of certain legacy issues and real estate prices in India, the threat for this sector is high, is perceived as high. And the vulnerability has reduced over a period of time. A lot of checks and balances have been brought in. Today, if a sale deed has to be registered, there's a lot of documentation which takes place. Biometric verification is taking place. Photograph, and a lot of KYC happens when the sale deed is registered in a sub-registrar's office. Today, even say for example in primary sector, we have the real estate regulators who are ensuring that all the checks and balances are in place. Third-party payments have been restricted in real estate sector. Cash payments are restricted in real estate sector. So over a period of time, actually the vulnerability has reduced now, but still it is considered to be medium. And because of that, the risk is perceived as medium high. From gems and jewelry sector, similarly, it is a tad less than real estate. The threat is medium low. And the vulnerability is also medium low, mainly because cash transactions are very limited. Above a particular transaction, there is quoting of PAN. And there's a limit to which jewelry sector actually can take money also. I mean, you cannot invest crores of rupees in gems and jewelry. unlike, say, for example, in real estate. So, but then even then, the risk is not low, it is medium low. Casinos are not a matter of concern in India. It is something which is there in many countries, but not in India. Professionals, where what we will be discussing today, are considered, the threat is considered as medium low, and now there are a few checks and balances which even professionals are exercising. The self-regulatory bodies, the institutes also have come up with all kinds of guidelines to ensure that professionals, their services are not misused for these activities, and therefore the vulnerability has to a large extent it has reduced, and the risk is medium low. And other financial institutions and like NBFCs and all, their scope in India is very limited, and financial inclusion services are anyway low because they only allow these are mainly Jan Dhan accounts and these financial inclusion services, PM Jeevan Jyoti Bima Yojana kind of products, where the risk is very low because the amounts involved are very low. Next. So I think Smarak, from here you take on.
Thank you, sir. Thank you, sir. So, so to continue here from.
Thank you, Mr. Pandey. It was, very beautiful presentation and very minutely sector-wise, bifurcation of the money laundering risk. So, of course, I would first, Mr. Smarak, before you start, I would like to provide an introduction to you for our, for our participants. So, am I audible this time? I just switched the mobile. Is it okay?
Yes, yes.
Okay. So, Shri Smarak Swain graduated in electrical engineering from IIT Kharagpur and joined the Indian Revenue Services in 2008. He has exposure in the fields of corporate tax audits, transfer pricing audits, international tax negotiations, the financial investigations. He has a master's in taxation and business laws from Nalsar University, Hyderabad, and a master's in public administration from Lee Kuan Yew School of Public Policy, National University of Singapore, Singapore. He is a director, FATF, in the Department of Revenue, Ministry of Finance, Government of India. He is also the co-chair of Working Group on Evaluations and Legal Issues, WGEL, in the Eurasian Group on Anti-Money Laundering activity and countering the financing of terrorism. Mr. Swain, I welcome you to this webinar. Our members are really very fortunate to have both of you as speakers today. So you may please continue from here.
Thank you. Thank you. So to continue from where Ritvik left, money laundering and terror financing, the framework in India is a unified framework for both money laundering and terror financing. But the nature of transactions of money laundering are fundamentally different from the nature of transactions of terror financing. So usually money laundering, so the transactions for money laundering are usually high value transactions, but the transactions for terror financing can be low value transactions. And that's the reason why terror financing becomes even more challenging, because the values can be low values, frequent payments, but low value. You can, for example, you can have a sleeper cell, or you can have a lone wolf character who is sitting at some place, and payments can be paid to him through a fintech app also. His expenses per month will not exceed 10,000 rupees or 12,000 rupees. So that's the reason why terror financing can be extremely difficult to identify, and the tracking of terror financing is markedly different from the tracking of money laundering. At the same time, for large terror activities, the financing aspect is for large terror activities, you need to marshal in a lot of resources for which the financing is significant. And whenever you see a significant financing happening, which is for a large terror activity or for some kind of a radicalizing project, you if you follow the money, you get to know, you get an early warning signal, which is actually useful for which has actually been useful in many cases for preventing terrorist activities. And that's the reason why terror financing, is as important as money laundering. In the national risk assessment exercise, what we did is we tried to understand the terror financing across the length and breadth of India, and then we divided the terror financing threat, the threat from terror financing, into 6 theaters. These include 4 regional theaters, region-specific theaters, and 2 thematic theaters. So the region-specific theaters are Kashmiri militancy and Northeast insurgencies, that is again in the Northeast, the left-wing extremism, that is in central India, and pro-Khalistani extremism, which is in the Punjab region. And the thematic theaters are radical Islamic terrorism and radicalism. Can we move to the next slide? And after dividing the terror financing threats into 6 parts, what we did is we prepared a matrix. In the matrix, we first of all looked at existing typologies and existing cases, and we identified 3 major ways through which financing happens. One is Hawala, one is MTSs, and one is through cash couriers. Other than them, there are new evolving ways of financing, such as through fintech apps and through virtual assets. Having said that, there are some principal modes through which financing happens. There's some principal modes of sponsoring terrorist activities. The first one is state-sponsored. We know very well that there are some theaters in which active sponsorship comes from an alien country that is Pakistan, and then organized criminal groups are also involved in financing of terrorism. Extortion is one of the is again a major mode used in some parts of in one of the theaters pertaining to Northeast insurgency. Non-profit organizations, NPOs, or which can be in the form of trust or societies, they can actually act as front for raising money for the purpose of terrorism, and also for arranging for some activities. So NPOs have been considered as an area of significant risk. At the same time, non-profit organizations generally are meant for charitable purposes, and we have found that most of the non-profit organizations in India adhere to high level of transparency. There are some which do not adhere to high level of transparency, and among them there is a subset where there may be some risk of being involved in terror financing activities. Then there's this issue of fake Indian currency notes, FICN. In the 2011 NRA, FICN was considered a high-risk predicate offense, whereas in the 2022 NRA, FICN has been considered as a medium-risk predicate offense. The reason is that after the 2016 demonetization, the prevalence of high-quality FICN has gone down significantly. The next major area of terror funding is narcotics financing. India is sandwiched between 2 major areas of narcotics production, and as a result of which there's a significant movement of cross-border movement of narcotics. And from the Western sector, whenever there is a movement of narcotics, it has been seen that in a few cases, from a few typologies, it has been seen that these kind of smuggling of narcotics items for the when the money has to go back, the money does not go in the same direction in which the goods have come. Rather, they are diverted for terror financing purposes elsewhere. Virtual assets. As regards virtual assets, there's something very interesting that we are seeing. We have seen traditionally, we have seen that the non-profit organizations, such as the trust and society, they are the ones which which are involved in raising funds and in disbursing funds. So they can be misused for raising funds from radicalized groups and then using it for terror financing purposes. But nowadays, a new channel has come up that is called the crowdsourcing. The crowdsourcing as a channel. Now, the problem with crowdsourcing as a channel is that they can very well raise value, not money, raise value from radicalized groups or radicalized citizens or sympathizers in the form of cryptocurrencies. For doing that, they just need to maintain a private wallet. And it's very easy to open up a private wallet. They do not have to, under private wallet is completely out of the system. You do not need to maintain any KYC for private wallets, due to which it becomes all the more easier to receive value in the form of cryptocurrencies and then liquidate the cryptocurrencies. But of course, once the value is received into a private wallet in the form of cryptocurrencies, the off-ramping has to happen. Off-ramping means that cryptocurrencies have to be converted into fiat currency. For doing that, they will necessarily have to go to an exchange. They'll have to necessarily go to an exchange and make a sale. For that purpose, the private wallet has to send money to a custodian wallet. That custodian wallet is a wallet which is hosted on a crypto on an exchange. So the cryptocurrency has to go to the exchange, and from the exchange, it has to be converted into fiat currency. That is a primary mode in which the terror financing happens, and because an exchange is involved, and because the exchange is following the FATF guidelines, because of that, the exchange has to maintain proper KYC norms, and also it has to report suspicious transaction reports, STRs, whenever it finds a suspicious movement in any of the custodial wallets. The last of the modes of terror financing is illicit arms trafficking. In this, actually, financing does not happen. Some organized group, what they do is they supply arms. They supply arms to the terrorists. If we can move on to the next slide. Okay, so after understanding these kind of threats from terrorist financing, a detailed plan was made in India over the last 4 or 5 years, over the last 6 years, and many steps have been taken for mitigating the risks. One of the key steps that have been taken is in international cooperation. So India actively provides international cooperation to other countries under its MLAT framework, that is Mutual Legal Assistance Treaty framework, and India also seeks cooperation from other countries. There are both formal cooperation, there are both channels for formal cooperation as well as channels for informal cooperation. And after that, capacity building workshops are done. Usually, the terrorist activities are handled by officers who have made a career in policing. So many of them may not have an active understanding of financing aspects. So that's the reason why it becomes more important to undertake capacity building workshops and to undertake training programs. And a significant number of training programs have been conducted for NIA, for state police authorities, and for various law enforcement other law enforcement agencies. Other areas of gaps have also been identified. For example, in the case of non-profit organizations, we have had a specialized risk assessment for non-profit organizations, from which we have identified the pockets of NPOs where the risk of manipulation is significantly high, and they are being monitored. The presentation, can I have the presentation back? Shreyas?
Yes, sir. Some issue happened, sir.
Okay, no problem. So I'll continue from here. So after ending terror financing, I'm supposed to talk to you about the sectoral risk assessment that we did for DNFPBs. Now, DNFPB, as Ritvik sir had also mentioned, is designated non-financial business and profession. DNFPB includes those entities who work as gatekeepers. Now, who can be a gatekeeper? Now, not every gatekeeper is an area of concern. What FATF did is that, what the member countries of FATF, including India, what they did is that, we'll move on to the DNFPB slide. What they did is that they made a thematic analysis. They did detailed research of typologies, and they found out some sectors which may be at a higher risk of money laundering or terror financing, or both. So after doing that research, they did a research on the sector itself, on the supply chain in that sector, and then they determined that there are some gatekeepers without whom transactions cannot happen, without whom financial transactions cannot happen in that sector. Okay, or without whom it can happen, financial transactions can happen, but generally does not happen. They usually work as a kind of gatekeeper or a middleman or a market maker in some market or the other. So DNFPBs, broadly there are 6 or 7 kinds of DNFPBs. If you can go to that slide on DNFPB. One DNFP, for example, is casino. So we know for a fact that in Western countries, a lot of money was laundered, okay, through casinos. Not only in Western countries, in Macau, for example, there's always a huge risk of money being laundered through casinos. So the casino has been made a gatekeeper. So the casino has been ability has been placed on the casino. So this saying that the casino has to undertake KYC norms, it has to maintain KYC norms, it has to maintain records, and at the same time it has to follow a risk-based approach. So what does a risk-based approach mean? Ritik sir has already told you. I'll explain it to you with an example. Let's say I am a client who is going to a casino. If I make a payment by cash or if I make a check payment which is of a high value, the casino the casino manager will ask me for my basic KYC details. He will say, do one thing, you give me a passport or you give me a PAN number. It is as simple as that. But if the casino manager thinks that I'm a high risk customer, then he will ask me for more number of things. That is called enhanced due diligence, EDD. If the casino manager thinks that I'm a regular customer and I'm not a risky customer, he thinks that I'm a reputed person, he knows my background, or he thinks that he's not of much consequence, then he will do a simplified due diligence. In a simplified due diligence, maybe you'll not ask me anything. You'll ask me only my registered mobile number. And then you just check whether my registered mobile number is in my position or not. I'm giving a very simple example. So the casino has a lot of independence in determining what kind of due diligence to be done, whether to do a regular due diligence or an enhanced due diligence or a simplified due diligence. And the regulator for the casinos, they usually give the guidance. They give a guidance. So on the top of it is the NRA, National Risk Assessment, which says how risky the sector is. Below that, there is a regulator. The regulator says, look, we generally find that these people are more risky and these customers are less risky. And below them is a level where the casino is there. The casino at its own level also makes its own AML safety policy. It will mark some kinds of customers as low risk and some kinds of customers as high risk. So those customers who have been branded as high risk, for them it will do enhanced due diligence. Those which have been considered as low risk, they will do simplified due diligence. To give you an example, in Macau, if I go to Macau and I say that MOP is the currency of Macau. If I say that I want to spend 20 Macanese per taka, then they will not even ask me for my passport. They will say that 20 MOP is a very small is a very small amount of money, and so we are not going to even asking for his PAN details. So that is how the risk-based approach works. So now coming down to the DNFPDs, I gave you the example of casinos. In India, as Sir said, casinos are low risk, mostly because casinos you will find there are only about 10 casinos, a few in Sikkim, a few in Goa. The ones in Sikkim are overland casinos, and the ones in Goa are overwater casinos. And after casinos, we have real estate agents. Real estate agents are regulated by RERA, Real Estate Regulatory Authority. And then after real estate agent, we have gems and jewelry center, that is dealers in precious metals and stones. That is a technical word, DPMS, dealers in precious metals and stones. After that comes accountants. Now, among accountants, there are three groups. You may be very well aware of them. Chartered accountants, company secretaries, of course, you people are. And then I think cost and works accountants. And then there are trust and company service providers. And then there are service providers dealing in virtual digital assets. Usually, these are the cryptocurrency exchanges and the brokers in cryptocurrency. If we look at the and then there is another sector called lawyers. In the national risk assessment, we found out that for the specific standards prescribed by FATF, because FATF does not want their standards to be applied everywhere. They want their standards to be applied for specific activities. For those specific activities, the NRA document determined that accountants are of medium risk and lawyers are of medium low risk. If you can move on to the next slide. So, so the next one. Oh, yeah. So I think we are at the end of the session here. At least my presentation is over. Thank you.
Thank you very much, Shri Swine, for making a threadbare analysis of the activities, the thematic areas, and types of terror funding, which will be a really great beneficial for our members, professionals, CS professionals. So members have been looking forward to some kind of clarity, and which you have provided through your slides. But I would really request you in future, please do not include us amongst accountants. We can be bracketed amongst professionals and not accountants. So that's just a request. And so thank you very much for a very beautiful slide and presentation with so many information and how and why we, the company secretaries, may be targeted. We are the gatekeepers, into the corporate world. So of course we do have the responsibility. So thank you very much. We had a question from the one of the participants, which was, which you have already covered. It was like whether PMLA is applicable to NGOs registered under section 12A of Income Tax Act. So you have mentioned that NGOs are big targets for that. So if you would like to add something on that, because you have dealt with that in at large. So if you would specifically want to add something to that question.
Yes. To be very clear, the NGOs which are registered under 12A or 12AA of Income Tax Act, actually the standard for registration of Income Tax Act is very high, because they see things from the perspective of leakage, from the perspective of tax leakage. So they maintain a very high standard, due to which there are some NGOs which are actually registered under section 12A. Other than them, there are other NGOs which are actually raising. There are other NGOs which are raising funds, which are raising donations and using them for charitable activities, but they are not registered on the Income Tax Act. They also come under the purview of PMLA. So not PMLA, under the purview of the AML safety framework.
Okay. Okay, thank you very much. I think that is very clear, answer to the question. So thanks again for your time, and our members have really greatly benefited from both your and Mr. Pandey's deliberation. And we would hope that in future, if there are some more sessions like this, as you mentioned that, awareness programs are being organized for the police and other, the other gatekeepers also. So, we would, at ICSI, we would really be requesting you that as and when we need, we would really knock at your door, and so that you can, come and also help our members to, benefit from that kind of an awareness. Thank you so much. And I would now request our next speaker, who's Dr. M. Satya Kumar. Before he starts the deliberation, I would definitely like to give a brief about his, background. He's, he has such a long list of qualifications that does not come in one screen or one mobile screen. So he's LLM, ACA, ACMA, ACS, CMA, ACMA, UK, CMA, US, MA Economics. That is something which I share with him. And then PhD. And he's an advocate with the Supreme Court of India. And I have had the privilege of listening to him and being associated with him also earlier. He's an advocate member of this Chartered Accountants of India, ICAI, Cost Accountants, and Company Secretaries of India. And those were included in his degrees only. And he's a chief mentor and administrator of Rajnikant Foundation, which human excellence and philanthropic organization started by Padma Vibhushan superstar Rajnikant. And Rajni sir affectionately calls Dr. Satya Kumar as Baba Saheb Dr. B.R. Ambedkar for his ideas for social transformation. So he Dr. Satya Kumar regularly meets Nobel laureates, His Holiness the 14th Dalai Lama, to discuss on business as an instrument of social transformation. And Dalai Lama named him as Tenzin Shikha. That's great, information. So you have a very huge profile, but I know our members are really looking forward to hearing from you, Dr. Satya Kumar. So I would request you to start your deliberation so that our members can benefit from your huge knowledge and expertise in this.
Thank you, Rupanjani. It's a great pleasure to address the members of the Institute of Company Secretaries of India. Thanks to Ministry of Finance, Government of India. Special thanks to Smarak Swain, IRS and officer at the Ministry of Finance, and Mr. Ritvik Pandeji, IRS. Am I right? IRS, Ritvik Pandeji?
IS, he's IS.
IS, yeah. So thank you so much. It was a wonderful insight because moment the notification was issued on May 3rd, 2023, and subsequently one more notification came in May 9, 2023. The next day, the headlines of the papers were very, very alarming. And in fact, what I understand is that without getting into the details, many of the newspapers went on to report as though CA, CWA, CS is covered under the Prevention of Money Laundering Act, without understanding the objective based on which they have been brought under the notification. First thing I wanted to clarify to all the members who are attending this program online is that having understood the professional ethics code and also the acts of the respective institute, and appearing for so many disciplinary cases of the members, I could tell you CS, CA and CWA as such, that is cost and management accountant, as such are brought under this notification only for the purpose of meeting the reporting obligation. So this is what I wanted to clarify. And in fact, for providing a background to this, the Ministry of Finance has clearly provided the presentation just before my presentation. They have listed out what is the purpose of Prevention of Money Laundering Act. In fact, they briefed about Financial Action Task Force. And to understand the brief about the FATF, the prevention of money laundering as such is a global call, which has been for many decades. In fact, in 1988, if I'm not wrong, 1988, there was a Vienna Convention that happened, and where the intergovernmental organization and governments discussed about how to combat the money laundering activity, which was actually triggering terror financing, and it was actually national security issues for many countries around the world, even for the developed nation. Following it up, there was a Financial Action Task Force. The objective of the Financial Action Task Force was primarily to combat money laundering and terror financing and adopt and implement appropriate measures globally to see to that these activities are not carried out, and to ensure that the countries mitigate this risk and over a period of time completely avoid the risk of money laundering leading to terror financing and other illicit activity. And there was establishment of European Council and Organization for American Estates and Council of European Convention, followed up by United Nations Global Program Against Money Laundering happened. And because of all this development that was happening, India was watching it. And in the year 2002, India brought out a regulation called Prevention of Money Laundering Act, Prevention of Money Laundering Act 2002. To understand this act, before Prevention of Money Laundering Act was there was Foreign Exchange Regulatory Act, which became Foreign Exchange Management Act in 1999. As such, from the perspective of income tax was taking care of the investigation. And from the perspective of course, service tax was introduced in 1999, and indirect taxes department was taking care of the same. And considering the money laundering activity was the global call, India passed this regulation in the year 2002, and it became effective from 17 January 2003. 17 January 2003, enacted by the government of India on 17 January 2003. and it became effective from July 1, 2005. From then on, the role of Enforcement Directorate started evolving, and one of the best officers around the world were brought under the Enforcement Directorate to investigate crimes which are listed, scheduled offences which are listed under the Prevention of Money Laundering Act. And even Enforcement Directorate also investigates offences under the FEMA Act. So we have to understand the money laundering has two important things. One is money laundering happening in the domestic level. Second, money laundering happening at the international level using foreign exchange as well. So considering all this development, India was notifying from 2005 onwards, Indian government was notifying reporting entities like banks, NBFCs for the purpose of getting the information, transaction information. And there was a clear-cut reporting framework that was evolved by the government of India. And we all know about the role of the Financial Intelligence Unit of the government of India under various reporting obligation. And there was a thumb rule like if there is a transaction of about more than 10 lakh rupees that has to be reported, and many more other reporting obligations were provided. So the clarification that every professional who is watching this program, especially the members of the Institute of Company Secretaries of India, is to understand that company secretaries are not covered under the Prevention of Money Laundering Act with respect to the professional work that we do. So very, very important to understand. With respect to the professional work we do, with respect to rather the core services of the company secretary in practice, core services of the cost accountant, core services of the chartered accountant is not covered under the May 3rd notification, May 9th notification. It's very, very important. May 3rd notification talks about financial transactions. May 9th notification talks about various activities, of course, leading to financial transactions. In the May 3rd notification, let us first deal with May 3rd notification. CAs in practice, CMAs in practice, CS in practice is covered, but what is covered is not audit service. What is covered is not secretarial audit. What is covered is not cost audit. Please understand, the core professional services of the members of the institute is not covered under the notification issued on May 3rd, 2023 by the Department of Revenue, Ministry of Finance. What is covered then? Very, very important to understand, because what was actually bothering me, next day when this notification came, all the newspaper, most of the newspapers I would say, started reporting saying that CA, CMA, CS are covered under the Prevention of Money Laundering Act. So Prevention of Money Laundering Act has various dimensions. So they should clarify under which dimension they are covered. So rather, they went on to report saying they are covered. So it is basically, before even I dwell into the details of the notification, I'm making a clear understanding to all the members that everybody should understand that core services of a professional are not covered under May 3rd notification as well as May 9th notification brought out by Department of Revenue, Ministry of Finance, Government of India. My dear friends, then what is covered? My dear friends, over a period of time, the Government of India understood professionals other than the core service areas, they were involved in many other transactions, many other activities. Those non-core areas are covered under the May 3rd notification, May 9th notification. This is what you should understand. Covered under what? In fact, this notification is actually a saving aspect for a professional, because whenever money laundering crime is reported, immediately even Enforcement Directorate goes and looks back who is the professional, who was his auditor, who was his company secretary, who was his cost auditor, and who is other professionals who are helping him. Then in that case, with this notification, what's going to happen for the professional, even before the enforcement authorities or even before the transaction could happen, If any of these transactions where you are already involved, in that case, you are going to report to the FIU, that is the Financial Intelligence Unit. Accordingly, you are going to save yourself from the liability. You are going to save yourself from the liability. So rather, every year or every periodically, there is going to be a reporting obligation for the professional. Accordingly, all those transactions which are entered by the professional, that is non-core practice areas, if at all, if you are entering, the notification does not prohibit the professional. Please understand, as per Article 14 of the Constitution of India, none of the notification can prohibit the professional from entering into any kind of consulting activity or any kind of activity. All that this notification does, if at all, if you are carrying out any financial transaction or activity, and it is notified under the May 3rd notification and May 9th notification, then the same need to be reported to the FIU. That's all. So what is being stressed upon in this notification is that professionals has to report the transaction and the activity. Now let us see, as per May 3rd notification, what are the transactions that is covered. First transaction that is covered as per May 3rd notification is that buying and selling of any immovable property. I was seeing the analysis presented by Mr. Smarang Swain. It was an excellent analysis where he went on to highlight that real estate transactions are the high risk prone areas for money laundering. Absolutely true. Because today, if at all, if the illegal money or dirty money or illicit money has to be laundered, the people mainly use the real estate, that is the immovable property, for the purpose of laundering. Accordingly, it is definitely a high risk because that is the area to be watched for. And many times the professionals help people in buying and selling. Accordingly, if you may note, the role of a company secretary, the core practice area is definitely not buying and selling of immovable property. But of course, if a company secretary is doing this transaction, it does not penalize. The notification does not penalize. The notification does not criminalize. The notification does not prohibit the company secretary or chartered accountant or cost accountant from entering this activity or this transaction. But it only says, if at all, if you are engaging in buying and selling of immovable property for a client, then report this for the purpose of Prevention of Money Laundering Act, Section 2, Clause SA 6 of the Prevention of Money Laundering Act. The second action which is covered under the notification, May 3rd notification, is managing of client money. Managing of client money, securities or other assets. Very, very important. Managing of client money, securities and other assets, management of bank, savings or security accounts. All these transactions are covered under the May 3rd notification. Even now, you can check the core activity of a company secretary or a chartered accountant or a cost accountant definitely will not be as if they are holding certificate of practice. Very, very important. The notification says CA holding certificate of practice, CMA holding certificate of practice, CS holding certificate of practice, and does this transaction or carries out this activity, then it becomes a reportable transaction. What is the transaction? Managing of client money, securities or other assets, management of bank, savings or security accounts. The next transaction that is covered, again, non-core area of practice for all the three professional, organization of contribution for the purpose of creation. Very important. Creation, operation or management of companies The point to be noted here is incorporating a company is a core service for a CS, CMA and CA. But operating and management of the companies is not a core practice area for all the three professionals. Accordingly, point to be noted here is where there is a requirement for clarification from the Ministry of Finance, which we also expect from the Ministry of Finance, is that in case of creation, what is the reporting obligation of a professional? Because he is not going to report about any transaction. Is he required to report about the entity that he floated? And here it is not the organization of, it is talking about organization of contribution for the creation. The question here is whether incorporation activity, the practice area where we incorporate a company, is it covered under this notification, or only when we organize capital, because it does not even say capital, it says contribution. The word contribution is not defined under the notification, which requires a definition so that we can get the clarity what transaction to be reported, whether should we report the incorporation activity of an entity, or should we report about organizing capital for the entity. So this has to be clarified, but however, if you are organizing any contribution, maybe it could be debt or equity. I think it could be debt or equity, both has to be reported for when it is used, when it is for the purpose of creation, operation or management of companies. Then the next activity which is covered as per May 3rd notification, where CA in practice, CS in practice, CM in practice, if they are entering this transaction on behalf of their client, the same need to be reported. First one, that is the creation, operation or management of companies, limited liability partnership or trust. Very, very important here. The point to be noted here is creation, operation or management of companies. So according to my interpretation, CA in practice, CS in practice, CMA in practice, they may not be involved in management of company. Maybe they may become a director, that too an independent director, or they may not be involved in the day-to-day affairs of the management of company, because if they are in active practice, they cannot run business. That is what the professional ethics of all the institutes say. If you are in practice, if you are holding a certificate of practice, accordingly, this possibility of a professional holding a certificate of practice and also managing the company or limited liability partnership on a whole-time basis may not be possible. But creating a company or creating a limited liability partnership is a core area of practice for a CA, CMA and CS who are in practice. In that case, whether the reporting obligation to the FIU is about the creating the entity and the name of the entity, what has to be reported has to be clarified by the Ministry of Finance, Government of India. The last transaction which is covered as per the May 3rd notification, wherein CA in practice, CS in practice, CMA in practice has to report, is buying and selling of business entities. Buying and selling of business entities. They are using a word called, the government use under the notification, they use a word called buying and selling. It is not talking about compromise and arrangement or merger and acquisition or absorption or demerger or reverse merger. The question that here that need to be clarified here is these areas of professional practice of merger, demerger, reverse merger, hiving off, amalgamation, whether if the professionals are carrying out on the consulting basis, on a consultancy basis, or even when they are in CA in practice or CMA in practice or CS in practice, there are some professionals also carry out consultancy services other than the core areas of practice. In that case, whether if they are involved in this consultancy work, whether they are required to report the same to the FIU, that is the Financial Intelligence Unit, and what is the framework in which they have to report, again needs a clarification. So what we need to understand here is the many of the professionals in this notification came, they were all afraid that if CA, CMA, CS, everybody is covered for all the activities that they do. That's not the case. Only these transaction when the professional CA, CMA, CS, they enter into, only these transaction has to be reported to the FIU. So it is a reporting obligation only. Once you report, what is a positive thing is you are relieved of the liability because you report to the authorities. Moment you report to the authorities, to an extent you are relieved of the liability, because in future, even if there is going to be investigation to be carried out on the entities that you floated or the activities that you carried out, because as you have already reported, the government has the data, and accordingly, to an extent, the risk can be mitigated by the professional. So what is the professional obligation? See, this notification is a very important step by the government, because as a country, we have to increase our rank, increase our standing as at the global level. And even officers were saying that many of the countries were provided financial sanctions if they are not meeting the FATF. Accordingly, it is very important to benchmark ourselves with the best practices around the world. So considering it, it's a very, very important step. But for a professional who are practicing, the framework need to be developed to see to that what is a reporting obligation, what is the quality standards to be maintained for this purpose of reporting. All this framework need to be developed, and platform also to be provided to them so that the reporting becomes easier for the professionals in a click of a button. So this is a very important step that the government should also facilitate the professional, or rather ICSI and Ministry of Finance can work together to come out with a reporting framework. Beyond this, on May 9th, there came a notification, subsequent notification, which is also a very, very important notification to be noted by the professional, which is also affecting the professional as such. But in May 9th notification, see, it is not CA in practice, CS in practice, or CMA in practice who is covered, because they are covered already on May 3rd notification. On May 9th notification, certain professionals are listed who are covered, and of course CA, CMA and CS is covered, but CA in practice, CMA in practice, CS in practice was not mentioned specifically. So what is covered on May 9th notification is that this is also notified by the central government under section 2 subsection 1 clause SA 6 under the Prevention of Money Laundering Act 2002. These are all some of the activities which are covered under the May 9th notification. Very, very important notification. The first activity that is covered under this notification, if any professional or individual carries out this activity, by default, they will become a reporting entity. That's my understanding of this notification. The first activity that is covered here is acting as a formation agent of companies and LLPs. See, what is my understanding is that as the notification was not defined what is a formation agent, what we should understand, nowadays many platforms are developed. Those platforms are used for the purpose of incorporation of the companies, where the work is shared to the professional. My understanding, by interpreting this clause of this notification, formation agent primarily could mean the platform providers through whom many of the professionals get job, the incorporation work, or LLPs through which they act as a professional to incorporate a company. My understanding, these platforms are covered as the formation agent. However, the notification has not clearly provided. It calls for a definition from the Ministry of Finance so that this definition can be a clarity for this clause. Second, acting as or arranging for another person to act as a director or secretary of a company. So, a partner of a firm or a similar position in relation to other companies and LLPs. Under this clause, anybody who is acting as a director or a secretary of a company or partner of a firm or similar position in relation to companies or LLPs, in that case, by default, those individuals will become or asked to report the activity. They become a reporting entity by default. The next clause which is covered, providing a registered office, a very, very important clause. For a long time, many of the professionals were benevolent in offering the offices for the purpose of incorporation of company, LLPs, many of the business entities of a client. But now, because of this notification, that is May 9th notification, skepticism has to be skepticism has to be exercised, and we have to check the background of all the client who use our office for the purpose of using the professional's office for the purpose of incorporation, because the notification requires you to report those entities. The third clause says, providing a registered office, business address or accommodation, correspondence or administrative address for a company or a LLP or a trust. So many a times when a client comes and says he does not have a place of business to do, many of the professional extend, whether it is CA or CMA or CS or some of the lawyers, they extend their office saying that you can incorporate your company here, let it be a registered office, later point of time you open an office and then you start your business. This instance is now covered under the notification. If at all any professional is offering their place of business as a registered office or business correspondence or accommodation, any of these activities mentioned under this notification, the same need to be reported. The point to be highlighted here is what was very interesting to note was accommodation. So this was very interesting to note. I really want to know what is the purpose of bringing the word called accommodation, because many a time professionals will provide their place of business for the purpose of registering or for the purpose of correspondence or for the business address, but it uses a word called accommodation. So I am really surprised how many professionals are involved in providing their office or their premises for the purpose of accommodate as an accommodation is a question mark. But however, I don't know the intent for which this word was included as part of this clause. Then the next clause which is covered is acting as or arranging for another person to act as a trustee of an express trust or performing the equivalent function for another type of trust. In all these cases, if they are appointed as a trustee or equivalent function for another type of a trust where they are appointed as a trustee, they will become a reporting entity. They have to report the this activity to the FIU. Then acting as or arranging for another person to act as a nominee shareholder for another person. Even in that case, the nominee shareholder becomes a reporting entity, and what he has to report? He has to report the beneficial owner. In fact, in the presentation just concluded by the Ministry of Finance, what I observed was the attention was paid for a word called beneficial ownership, BO, because many a times there will be a beneficial owner, but somebody will be a nominee. And of course, these transactions are covered under the Prohibition of Benami Properties Act, if it is a property transaction or any of the transaction relating to asset. But the same need to be reported upfront so that the government knows who is the beneficial owner behind a nominee. So with this intent, the government of India rightly has brought this notification at the right time to ensure that India meets the standards, benchmarks itself at the global level, so that the reporting obligation increases. Nowadays, most of the time before 10 years, crimes were mostly deductive in nature. Crimes will happen, after that the authorities will go, they will deduct the crime. But nowadays, the steps taken by the government in the past 6 years, diligent steps taken by the government by various departments shows that government is very, very clear that they wanted to prevent the crime happening, especially in the areas of money laundering, areas of relating to corruption. And in fact, if you read the intent of the legislatures also, it is Prevention of Corruption Act. Similarly, if you read the intention of the money laundering also, as per the act, it is Prevention of Money Laundering Act 2002. It is about preventing. So accordingly, to prevent these activities happening, because post happening of the event, it is very difficult to investigate. We see that Enforcement Directorate arresting various people involved in this crime, and they also were many of these criminals or accused who are accused of the money laundering crime. Mostly they don't come out of the bail, because in case of the economic offenses, jail is a norm, bail is an exception. In case of the other criminal, if you see the criminal jurisprudence with respect to other crimes, it is bail is a norm, jail is an exception. Because in 2016, there came a Supreme Court judgment which very clearly mentioned as an observation, in which they clearly mentioned as an observation, economic offenses are the crime against the society. Because this observation has to be understood, because if this economic crimes are not curtailed, this will affect the financial architecture of India. Because of that, India cannot progress, or over a period of time cannot benchmark itself to the global standard, and resulting to that, the bank's quality, the financial inclusion has to be brought in. The standing of India will go up at the global level. So considering all these requirements, there is a global call today, and the government of India is rightfully notifying the professional who are the gatekeepers and who are designated non-financial business and professionals. Under that category, we become the gatekeepers for most of these transactions. Accordingly, it is very important, when we are gatekeepers, when we are watchdogs of this transaction, as per the Kingston Cotton Mills case, chartered accountants or watchdog are not bled out. So accordingly, when we are watchdogs, and when professionals look at this transaction, and when we are not able to judge whether this transaction is money laundering transaction or not, it is better to comply with this notification and report all the transaction which is entered on behalf of the client, so that we are at least to an extent relieved of the liability, and we promote transparency with respect to the professional. So it is all about transparency being brought into the system. It is helping all the professional, an excellent step by the government of India, wherein the reporting obligations are brought for certain activities and for certain transactions. Of course, it requires clarity from the government with respect to certain terms, with respect to certain definition. I am very sure that the government of India, Ministry of Finance, will clarify this notification over a period of time. Considering this is a wonderful step taken by the government, not to criminalize, not to penalize, not to prohibit the professionals from entering into the transaction, but to bring transparency, but to ensure that the professionals are not brought under the liability unnecessarily in the future because of money laundering activities. Thank you so much for this wonderful opportunity. I tried to deliberate on both the notification in a detailed manner. In fact, last week I deliberated this in the Southern India Regional Council for more than 2 hours, because the issues are multiple level. What is the obligation of the reporting entity? How it has to be reported in the FIU? What is the role of the FIU? What are the transactions which are connected in the FIU? For example, there is a STR where need to be reported where the transaction is more than 10 lakh rupees. But if it is integrally connected, even by integrally connected, if it is more than 10 lakhs, the same need to be reported. So there are many more obligations under the FIU, but we need to understand in this kind of transactions that is mentioned as per May 3rd notification, May 9th activity, irrespective of the threshold of the transaction, any amount of transaction has to be reported. So it is a completely separate code, separate process to be followed by the professional. Very, very important as per May 9th notification, which I missed to enlighten. As per May 9th notification, if a professional, that is chartered accountant, cost accountant, company secretary, who is engaged in the formation of the company, is exempt from reporting to the extent of filing only declaration form. Very, very important development, Rupanjani ma'am, because this has to be noted by all the professionals across the country who is watching this program. The government of India, the Department of Revenue, Ministry of Finance is very, very clear. As per May 9th notification, if a professionals are involved in incorporating company and they sign a declaration form, they are exempted from reporting the creation of the entity activity under the May 9th notification. It's an exemption provided under the explanation to the notification. Second important activity which is exempted, any activity that is carried out, very, very important, any activity that is carried out as part of any agreement of lease, sublease, tenancy, or any other agreement or arrangement for the use of land or building or any space, the consideration is subject to deduction of income tax if the payment is made after deducting TDS, step 1. 2, if there is an agreement in place for lease and sublease, then that activity need not be reported as per May 9th notification. So second exemption, if it is going to be a rental agreement where people have letted out the commercial space, accordingly they need not report the activity. Third important activity which need not be reported, the exemption, any activity carried out by advocate, chartered accountant, cost accountant, company secretary, of course in practice, who is engaged in formation of company, which I already told you, to the extent of filing declaration form, is exempted from reporting. Any activity which falls within the meaning of the intermediary need not be reported by the professionals as per May 9th notification. So the impact of Prevention of Money Laundering Act with respect to May 3rd notification, May 9th notification is that all these activities, all these transactions are mentioned or rather notified under section 2, subsection 1, clause SA. Now let us understand, before I conclude, what is section 2, subsection SA, clause 6, very, very important. It says persons carrying on such activities as the central government may by notification so designate from time to time. Very, very important. So whether May 3rd notification and May 9th notification, only those activities and financial transactions will be covered forever, or the central government has the power to notify more activities and professional? Answer is yes. In fact, what I expect is in future, even notary public could be brought under the notification. Even notary public could be brought under the notification, because many of the times with respect to the real estate transaction, as I see that there is a high risk with respect to real estate transaction, possibly the government of India or Ministry of Finance, Department of Revenue, over a period of time, bringing out a framework for the notary public or the commission of oaths, they may also be brought under this notification over a period of time. For example, to bring more people under the inclusion. So it's a ever evolving process. So accordingly, as per section 2, subsection 1, clause SA 6, more activity and transactions and professionals will be notified over a period of time. As the FATF brings out more developments at the global level, I'm very sure India will start catching up with those developments to see to that the reporting obligation increases. So accordingly, May 3rd notification, May 9th notification, in summary, brings a reporting obligation for the professional. CA in practice, CS in practice, CMA in practice, and many other activities they carry out, which is mentioned as per May 9th notification. Accordingly, it is not alarming, it is not criminalizing, it is not prohibiting, it is not penalizing the professional, is the conclusion, my dear members. Thank you so much for this opportunity. Thanks to Institute of Company Secretaries of India. Thanks to Ministry of Finance, Government of India for this wonderful program, where we had an excellent deliberation by the officials of the Ministry of Finance, where they provided entire gamut, what is all about money laundering, what are the activities covered, what is the risk area, what is NRA. So it's an excellent initiative. Thank you so much, ICSI and the leadership of ICSI and the officials of ICSI for putting out this program here for the benefit of the members across the country, across the world. Thank you so much.
Thank you, Dr. L. Satya Kumar, for a very beautiful deliberation and word by word analysis of both the notifications dated 3rd May and 9th May. We have actually received a lot of questions, and I really wished we had the representatives from the ministry, but I can see they are not in the Zoom call at the moment. So but with your experience and your expertise, you would be able to answer all of them, I'm sure. So I'm just going, taking you through the questions. The corporate professionals like CS, KS, and cost accountants are covered under PMLA, whereas employee of a main promoter company are usually appointed as directors on share companies. Why not those employees are covered under PMLA?
Yeah, you see, in fact, as per May 9th notification, they very clearly said that the employee-employment relationship is not covered, because we have to understand here the directors of those entities are covered. The secretary of those entities are covered. So we cannot make all the employees of the organization to be covered. Accordingly, the employee-employee relationship has been provided as an exemption under May 9th notification. It's an excellent question, because well thought out question, and it is very clearly provided for the purpose of section 2(1) clause SA 6 of the Prevention of Money Laundering Act. B says any activity that is carried out by an employee on behalf of employer in the course of or in relation to his employment is exempted from reporting. Take for example, there are 6,000 employees working in an IT company, and of course, what is the purpose of making them report? So you cannot ask an employer to report. There are many reasons why they should not report, considering the professionals who are involved, who are in the process of decision making, and for example, directors become reporting entity. So whoever is the gatekeeper has to report. So employer-employee relationship is not a gatekeeper relationship. So we need to understand, as a professional, we are the watchdog, and directors are into the management of the company, or the trustee of the trust is managing the entire trust. So the object of this notification is to see to that people who are sitting on the helm of affairs report this transaction upfront to the government of India.
Thank you so much. Now that brings me to a very similar question, which is when a practicing company secretary is appointed as independent director of a company, will he be treated as a reporting entity as per notification dated 9th May?
Is it an independent director?
Yeah, a practicing company secretary who is appointed as an independent director.
Rupanga ma'am, if you see the May 9th notification doesn't say independent director, nominee director. It doesn't classify as old-time director. It only says director. This also requires a clarification from the Ministry of Finance. Who are all the directors who are covered? Or the intent is to cover all the directors. My understanding is that the intent of the May 9th notification is to cover all types of directors to report the transaction.
So I think we will the institute to take a clarification on this point from the ministry for the benefit of our members. And the next one, next question is very interesting. Like, are these notifications giving any indirect powers or authority to the CS professionals to have a control to prevent money laundering?
In fact, when I opened up the session, Rupanga ma'am, I clearly told that the notification issued by the Department of Revenue, Ministry of Finance, Government of India is not prohibiting, is not penalizing, it is not criminalizing the professional. It is only trying to actually protect. In fact, from the helicopter view, we can understand that by reporting a transaction upfront, to an extent you are relieved of a liability. I'm using the word called to an extent. To an extent. I'm not saying 100% you are relieved of a liability, because as you report, and let's assume, I'll give a classic example. There is a professional CS in practice, or CA in practice, or a CMA in practice incorporates a company. And after incorporating a company, he will not even know what is the transaction that the company is entering into. But what's happening right now? Enforcement Directorate recent times comes directly into the professionals and then asks, why did he incorporate? And the professional don't even know what transaction happened after incorporating. So here, through this notification, indirectly or directly, it is safeguarding a professional. How? Because moment there is a creation of an entity, that is company or LLP, the same need to be reported. Once it is reported, to an extent, the liability is relieved for a professional, because the government has the information upfront. So this is in fact a safeguard for the professional, is what I would say. How do we, based on the way we are going to evolve the framework for the same, the result will be effective. So we have to evolve a wonderful framework of reporting. And I'm very sure the leadership of the ICSI is already working on it, because that's what I understand from the interaction from the leadership of the ICSI. They have started working on the framework. They started working on this. That is the reason we have put forth this program. And once this framework comes, it is at the ease of the professionals to implement or report this transaction and get away on the liability to an extent. Rupandra ma'am.
Okay, thank you. The next question is on understanding of account-based relationship from a participant. Which comes in RBI Master Directorship, KYC client due diligence under TML rule. Does that mean a bank account opening or the creation of an account tally like a merchant account? My company has got RBI license as a payment actor and needs to understand whether all the provisions for payment actors also.
Yeah, this is covered under the May 3rd notification. May 3rd notification. Rupandra ma'am, your voice is crumbling.
This is too technical a question. Can we have a clarification from the minister in this regard? Do you think, would you suggest that?
Yeah, I would suggest, or rather you can even write me a mail. I'll share the mail and mobile number at the end. So I'll understand. Maybe it requires a more in-depth understanding, probably.
Yeah, it's a long one. So next is the serious concern of most of the professionals today. It is professionals get used to amount in advance from the clients for paying ROC, filing fees, GST payment, etc. Now later it is adjusted.
Rupandra ma'am, your voice is crumbling. Your voice is crumbling.
Just a minute. Just a minute.
Yeah, thank you. Thank you.
I'll just switch off the video. Yeah, okay. Am
Sure.
I audible properly now?
Yes, Rupandra ma'am.
Okay, so now the participant is asking that, sometimes we take advance from our clients for payment of GST and fees and ROC filing fees, and these are later adjusted as reimbursement of government fees. Now, will these be considered as money laundering? I believe this is what we are talking about all the way through. So
actually,
yes,
Rupandra ma'am, you are right. That's a wonderful question to be asked, because these are a basic question affecting any professional. Appreciated. This question is appreciated, because the managing of client money definitely will call for if you receive money in advance to pay the government dues, definitely it will be under the managing of client money. So this is where the clarification is needed. Probably an exception should be drawn out, or clarification should be provided by the government, understanding the practical difficulty of a professional. In fact, many a times, professional himself will pay the tax or the required fee for the government on behalf of the client. Whether this scenario is covered under this notification or not is a question mark, which requires a clarification, Rupandra. A very valid question.
Okay, so next we have this question. The master directions of NBFC state that investment exceeding 20% from non-compliant FATP jurisdictions shall not be treated at par with other investment from FATF compliant jurisdiction. Please throw some light on what will be the difference in the investment received from non-FATF compliant jurisdictions.
I think it's too technical, so probably I'll put out my mail ID and my mobile number. So
Similarly, I think I request all members to we have received a whole lot of questions. Some of these have already been covered in the sessions, and especially Mr. Satya has already done a very word by word analysis, but some are very typical questions relating to particular situations. So we have those in our repository, and in case of the very technical questions, we would reach out to the ministry, and also we will share with Dr. Satya Kumar. Then maybe I'll just take one more question, because we are approaching the end time. So please inform whether the nominee shareholder appointed in the company, a newly incorporated company having foreign company as shareholders, and nominee shareholder has to be reported under the PMLA guidelines.
Absolutely, because May 3rd notification very clearly says that creation, operation or management of company, limited liability partnership, trust and buying and selling of business entity is covered. Add to that, one more thing that is covered under the May 3rd notification is organization of contribution for the creation, operation or management of company. But very important point to note here is, it is all for CS in practice, CA in practice, CMA in practice. If a CA is not in practice, not holding certificate of practice, CS is not holding a certificate of practice, CMA is not holding a certificate of practice, then it need not be reported.
Okay, thank you so much. Just last one questions. Do FIUs of various countries exchange sensitive personally identifiable information as part of the cooperation? Obligations as member of FATF, is there an expectation of dual reporting by the regulated entities in the respective jurisdictions if it is a cross-border transaction and two FIU jurisdictions are involved?
Can you summarize the question, Rupana ji?
It is talking about like when FIUs of various countries exchange sensitive personal identifiable informations as part of its cooperation amongst the FATF members. So is there any expectation of dual reporting by the regulated entities? The regulated entity, do they have to report to both the the FIUs of both the countries if it is cross-border transaction and two FIU jurisdictions are involved?
So if the FATF regulatory regulations require to report, it is to be reported. So there are many transactions where it is a G to G level. So according government to government level, regulatory department has to take a call about it. So as far as this notification is concerned, the professionals are to have to report only to FIU India. Very, very important. There can be FIU Germany or there can be FIU in other country where the profession need not report all these transactions. For example, a private equity firm through which you have arranged contribution, that is equity to a company in India. Probably the private equity firm will be domiciled at Mauritius or Cayman Islands or British Virgin Islands or Luxembourg in a tax haven. The professional need not report to the FIU in the tax haven. The professional has to report only to the FIU in India as per the May 3 and May 9th notification.
Okay, thank you so much, Dr. Satya Kumar. I'm happy to inform you that close to 16,000 members, participants are watching this webinar at the moment. So, like,
if they have any clarification to write to me, they can write a detailed mail. I have my mail ID is SATHYAKUMAR at Tycoon Legal TYCOONLEGAL.com. Tycoon Legal Satya Kumar SATHYAKUMAR at tycoonlegal.com. And I'm also there in LinkedIn. You can connect and you can share your questions. I'll go through at my leisure and definitely I'll reply back because this is my area of interest and this is my area of practice also in many of the aspects. So definitely I'll reply back to the questions and members are assured of a valuable answer.
Thank you so much. I have something to say to the members also, like as has been clarified by all our three speakers today, there is no direct threat to the professionals. Of course, it's not that the profession itself is being targeted. It's certain transactions. Only when we enter into certain transactions, we fall under the purview of the PMLA. So it is for us to take care and be very careful about when we are dealing with doing any such activity or dealing with the client's money in certain cases. And the Institute of Company Secretaries of India is making representation. It will also in future be making representations to the ministry in case so they most of it is what for the so there is no reason to be afraid of that. So since as long as there is no direct threat to the profession, there is no threat. So just that we as gatekeepers of the corporate world, we have to be more cautious when we deal with clients complete, background of the clients. We have to know where money is coming from, and we have to know what kind of, transactions and activities we should keep away from. And since this PMLA, these notifications are very new, we all know that, clarifications keep coming once a certain new legislation is enacted or any notification is, made. Then a lot of clarifications do keep coming up, and then that will help to clarify the situation all the more. So there's nothing to worry. But of course, on behalf of the council of ICSI, I would request all the members to not to involve in any such activities which are coming under the PMLA umbrella, and or help any such company or people who we know that may be involved in such kind of activities as listed. Any terror activities or terror financing activities. So we really have to be very careful. So thank you very much, Dr. Satya Kumar. It has been a lovely deliberation, very threadbare explanation. And I also thank all the participants who have taken time to log in and be part of this webinar today. And the questions that have remained unanswered are either because they have been already covered by the speakers during their presentation, or because they are too technical and they need to be sent to the ministry for clarification, and the institute will in due course share these as FAQs or in some form. So that's it. Thank you very much. Have a lovely evening, all of you.
Thank you.
Satyaji, thank you very much.
Thank you, Rupanjanaji. Pleasure. Thank you. Thank you, Smaran Smayanji.